whilst the treasury bills, 91-day treasury bills specifically, made 30.39. Okay, along the line, okay, inflation, when you discount inflation, which was also around, let's say, 17% over that period, we realized the stock market actually made 17.73% real return if you discount inflation. Okay, whilst treasury bill made 8.08. So if you're a young man and you put your money in such an investment over the long term, for us, you have lost. Yes.
No, hold on.
Okay.
If you invest in treasury bill from 1996 up till now?
Up till 2005. So we did another one also from 2006 to 2016. Okay.
Share that one also with me, then we continue the discussion.
Okay. This is also what we came out with. Treasury bills averaged 17.90, okay, over the period, while the stock market did 14.37. In this instance, you realize the stock market did lower than T-bill. Okay. There are factors that we could attribute to this kind of performance.
What are those factors?
Okay. Over the last period, we've gone through some economic challenges, okay, and that has reflected, and it reflects, normally, stock exchanges, they perform on thriving economies, okay, so when the economy is very good, the stock market also performs, and it is just based on expectations, okay, while the treasury bill, just as you said before the show, you're able to tell what you are getting at the end of the year. We do our projections in the stock market, and we're able to project, okay. So within that period, we realized the stock market did lower, okay, but along the line within that period, okay, 2009, the market returned minus 46, okay, which is not good enough, minus 3.1, 2011, minus 11.77 in 2015, and just last year, 15.33, okay. But if you look at what happened in between 1996 and 2005, okay, the only negative returns were minus 15.22, okay, and 29.72. That is 1999 and 2005 respectively. Okay, and there's also what you realized. There was kind of stability within that period. Okay, if you check the GDP growth over that within that period, you realize it was hovering around 4.2 and 5.9. Okay, and that is enough stability for the stock market to perform. But in the last time, between 2006 to 2016, this is what we realized. 2008 was 9.1%, 2009 4.8, 2011 14. That was the highest within the period, and it came down to 9.3 in 2013, 7.3 in 2014, and just last year projection around 3.3. Okay, so the stability really wasn't there for the stock market to thrive.
Yes, but so how did you come by that? So assuming you're a young person and you're investing, regularly in the money market, for instance. Okay, mind you, yes, the money market, there's a treasury bill, but sometimes the money market is higher than the treasury bill rate also, even though you say that one is also a short term. Yes, but in investing in that, if I look at, say, a treasury bill rate, okay, now it's around 17% or so. 16%, yes, and the inflation rate is around 15. But if you look at the development on the stock market, it's poor, it's in the negatives.
Yes, it's in the negative because if you look at the stock market in the short term, okay, you won't always buy into the idea of investing in the stock market. In fact, over the 20-year period that we did the analysis, okay, this is what happened, this is what we found out. Even though the last 10 years was a bit difficult, the stock market proved to be in a better position than the money market, as in treasury bill. Over the period, T-bills averaged 23.87, while the stock market returned 26.59. Okay, discounting inflation, T-bills returned 6.23, while the stock market returned 8.9. Okay, so even with putting together the two periods, okay, realize the stock market was always ahead. Yes.
So it means it's better to invest in the stock.
It's always better. For the long term, it's always better. Keeping your money, people also would like to see their money in the bank accounts. I mean, that one, they are even worse off. Because the banks are giving 3%, some 5%, and averagely it's been around 10 or 11%, which is a negative return already. Okay, so it's always better. The stock market, there are some performing stocks. You speak to your analyst, okay, to select those performing ones, okay, to put your money in. Always there are people who would seek for those stocks. So it brings about liquidity. You can talk of the banks and fund milk, some of the manufacturing companies and the rest. They are always doing well. So it's always better to put your money in the stock market in the long term than in the money market.
Yes, but in putting, so let me get this explanation. So assuming I decide, for instance, that every month I want to put money in, say, a money market, a treasury bill. So over time, so every month I say, take my salary and I say, oh, I've dedicated this amount. Over time, that should get me a very good, retirement package, shouldn't it?
Yeah, it will, but in real terms, you've lost.
How have I lost?
Inflation, looking at the way inflation performs. When inflation is going down, treasury rates.
Yes, but there's also that challenge, Kofi, that for all you know, I might put my money in a stock that might not perform.
Yes, that's why you have to speak to an analyst.
The analyst could get it wrong.
Yes, it happens. So we have what we call portfolio management. We don't put all your eggs in one basket. Okay, we do a selection of stocks. Okay, in case one is not doing well, you don't put all your money in the banking sector. Okay, there could be a crash in that sector and it could affect all your money. Okay, so we select the performing ones in various sectors. And you are better off than somebody who put his money on the table.
Really? All right, so listeners, that's it here. Listening to Kofi of UMB Stockbrokers telling us that it's good to put our monies in a stock. So rather than keeping our monies in, T-bills. And for those of you who keep it at the bank, just like that, you're losing out big time. What of fixed deposits? I mean, that's, you go to a bank and you negotiate with them and you say, I want to give you this amount of money. I want an interest rate of, say, 30%, 20% per annum. And you do that.
Yeah, those ones, they are pegged to the T-bill rates. Okay, normally, when T-bill is, let's say, around 20%, okay, you can negotiate higher than T-bill. So once T-bill is going down, you don't expect fixed deposits or those kind of instruments to also stay high. The higher you go for, the riskier it is. You have some of the institutions not being able to pay investors. It's happening in the market. So you need to, once you're asking for a higher return, then you should be ready for the risk. Yes.
But there's also, that person who feels that investing in, again, coming back to the stock bit, so you invest in the stock, then there's a shock, the money goes down. Because, the thing about the stock market is that while you have a guarantee, in the treasury bill or the money market, when it gets to the stock market, you could invest in it and then everything goes down. So like this, what we're experiencing now, a minus what performance? 15. And there's one stock, I don't want to mention the name of that particular entity. It's a bank actually. Now it used to be trading at 30-something Ghana cedis. It's reduced to less than 20 Ghana cedis. And I'm sure you know the bank I'm talking about. Yes, so it's such a situation you've lost big time.
Okay, earlier I mentioned about portfolio management. Okay, when you come to me, for instance, with 500,000, okay, just an example, you don't expect me to put all those monies in the stock market. Okay, what we do is we do an assessment of you yourself. Okay, we take a risk profile of you, and we know what percentage are we putting in the stock market and what percentage are we putting in the money market. Okay, we also assess your needs. Okay, you may want to assess your funds on a periodic basis. The stock market is not okay. So the percentage that we put in the money market, you could be able to assess it over time. Okay, so that is what we do. Portfolio will select a portfolio for you, so that anytime you need money, you can fall on the money market aspect, so that the long-term one, the stock market, can run till you want to retire.
So that's more like a blend.
Yes, it's a blend.
So in effect, it's good to do a blend.
It's perfect to do a blend. You know yourself, you make an assessment of yours, and then you do a blend. That is best.
Okay, let me just get our listeners in at this point and find out. Those of us who are working now and we're thinking of, planning our retirement, you can join the conversation now. Just join us on 0302 763 455. That's the number that you're using. 0302 763 455 0302 763 455. So we're talking about how you can effectively plan your retirement. But Kofi, apart from say investing in a stock or the money market, anything, any other investment that I could do that would ensure that I have a secured retirement?
Well, I wouldn't be able to mention, but the others who also go into real estate and others, but I'm not in a position to speak about that. What I know for a fact is that the stock market has over the years been performing better than the money market, and we do the selection based on the needs of the individual, or they say that the number of years to retirement. Okay, we do all this assessment to be able to tell whether it's okay to put 70% of your current funds in T-bill or to put 70% in the stock market.
Because I know there are some people who go into land banks, they would go into getting lands and here and then, and they believe that once they have the lands, they could actually help them, to be able to, because land value appreciates, so much. I mean, I'm sure that appreciates more than even treasury bills and
Sure.
the stock market.
But the situation in this country, getting lands is also a risky venture. With this land guards and all that,
Also get the right one. Anyway, so the phone lines are still that you should, help me, invest in, say, what percentage of my investment should be in the stocks and what should be in the money market or treasury bills.
Okay, for you yourself, okay, what I'll ask you, how many years you have to retirement? Okay, how many years you have retirement? How much money are you bringing? Are you able to take the shocks of the market? Okay, if these questions